In this video, we're going to look at Wendy's, the fast food restaurant. And what I do in my videos is I try to figure out the intrinsic value of a stock by using my discounted cash flow model. And we also look at the financial ratios of the company and compare them to similar companies in the same industry. So let's get started with the model. Wendy's has a market cap of $4.88 billion. And they trade at $21.89. Now we need the free cash flows, and this is the cash that's left over after paying your expenses. And the way to value a company is you have to estimate their future free cash flows and then discount that number back to today's value. Next, we need the net income, which is the profit and loss on the income statement. And we're going to put 4 years of that into the model. I'm going to put 4 years of revenue into the model. That comes from the income statement, the revenue. And these are the sales from the corporate level. The royalties the corporation charges its franchisees, and also the franchise fees it charges, not the actual sales of the products like the burgers and fries in the store. Those are on the franchisee level. I'm looking at Wendy's on the franchisor level. Let's look at the capital structure of Wendy's to figure out what discount rate we need to apply to the future cash flows. So the interest they pay on their debt is $116 million, and that's from the income statement. And to figure out how much debt they have, we'll go to the balance sheet, then go to liability section. Under current liabilities is current debt. Debt due within 1 year, that's $23 million. And then we'll go to non-current liabilities. The long-term debt of $2.3 billion is due after 1 year. So they pay 5% interest on the debt. Interest is tax deductible. So let's go back to the income statement and get their effective tax rate. So the income before tax is $171 million. And the income tax is $35 million. So they pay 20% in taxes. So the cost of debt is 4.1%. And the cost of equity, we need the beta for that. So that's back in Yahoo Finance. And the beta is the volatility of the stock. So the higher the beta, the more volatile the stock is. It's not too bad, the beta, 1.25. So the stock moves about 1.25% of the market. We need some more information because we're going to look at the ratios later. So let's go back to the balance sheet and get their current assets. And these are the assets that I use to run its day-to-day business. It includes cash, accounts receivables, and inventory. And that's $550 million. And we need their current liabilities. These are liabilities that are due within 12 months. And that's $350 million. And the equity is the value of the company. It's total assets minus total liabilities, $516 million. And let's go back to the income statement and pull their EBIT. That's earnings before interest and taxes, or operating income, $285 million. So now we know the weighted average cost of capital. It's a blend of the cost of debt, which is 4.06%, and they have 82% debt in their capital structure. You combine that 4.06% with the cost of equity, the 11.84%, and to figure out cost of equity, we use the capital asset pricing model. And the equity in their capital structure is 18%, so they're much more debt than equity, a bit leveraged. The weighted average cost of capital is 5.5%, and that's what we're going to use to discount the future cash flows by. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today's values, and we get a value for the entire company of $1.9 billion. We divide that by 223 million shares. We get an intrinsic stock price of a little over $8. And they're trading about $22, so it's trading at a 163% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company at. They value at $10.67, so that's right around what I'm valuing them at. So we're both in the same ballpark, saying the company's overvalued and it's not worth $22 a share. Let's look at the historical stock price. So it looks like it was trading closer to intrinsic value 5 years ago, but the price has gone up quite a bit over the years. It did drop when coronavirus hit, but it came right back up. So I guess sales in Wendy's have been strong, or at least the market sentiment for Wendy's is positive because investors are willing to pay a premium for this stock. Now let's look at their financial ratios. They have a poor PE of 35.6. That's price to stock over earnings per share. That means investors are willing to pay $35 for $1 of earnings. Price to sales is pretty good at 2.9. That's price to stock over sales per share. They have a pretty high price to book. It's not so great, 9.5. That's price to stock over book value per share. They have a good current ratio. They can cover their current liabilities, 1.6. ROE at 27%. That's pretty good. Interest coverage ratio, they can cover their interest expense 2.5 times. That's EBIT over interest expense. And debt of 82%. So they do have quite a bit amount of debt. And the best way to look at ratios is to compare them to companies in the same industry. So I have Cheesecake Factory, I did a video on, Chipotle, Denny's, Darden, which owns Olive Garden, MTY Group, a Canadian company, Dave & Buster's, QSR, which owns Pizza Hut and Kentucky Fried Chicken, Starbucks, and Wendy's. All pretty significant large entities. So Wendy's is the video we're doing, and if the number's in red, they're worse than the average. And if it's in green, they're better than the average. And they're almost all red. So obviously, it's an indicator that it's an overvalued stock because they're not even doing well against their peers either. And if the number is in orange, that means they're the best in that category. So Denny's has the best PE at 5.1. Wendy's has the worst PE at 35.6. Wendy's is worse in price to sales ratio. It's not too bad, 2.9. This industry just appears to have really good price to sales ratios. They're doing awful in price to book. They're at 9.5. At least they're not negative like Starbucks and Denny's because they have negative equity and they're 100% debt, those companies. The only category they're doing better in than their competitors is current ratio. They can cover their current liabilities. Almost all the other fast food chains cannot cover the current liabilities, which is not a good thing. ROE of 27%, higher than the average of 3%. Dave & Buster's is number one in that category at 59%. This is a pretty leveraged industry. Most of these companies have a lot of debt, except Chipotle has no debt at all. Darden is pretty good in debt at only 35%, and MTY is also good in debt, but the rest are pretty damn leveraged. In terms of market cap, Wendy's is smaller than the average of $18.9 billion. Starbucks is the largest of this list of companies. So it's an interesting company to look at. It seems like it's overvalued, but let me know what you think. Is it overvalued? What's your opinion? Thanks for watching.